Hello, I'm Ali, and in this video we'll talk about the internal controls objectives. It's important for the auditor to understand the objectives of internal controls. While the auditor links controls to audit assertions and account balances, the objectives of controls connect the auditor's understanding of why the controls are important and the issues they are designed to prevent. The reason an organization puts internal controls in place is to ensure errors in the processing of transactions do not occur, and if they do occur, then these errors are identified and rectified as quickly as possible. There are 7 generally accepted objectives of internal controls that are used to determine whether an internal control environment as it relates to the recording of transactions and balances is effective. Internal controls are designed and implemented to ensure that transactions are real, recorded, correctly valued, classified, summarized, and posted on a timely basis. When the objectives of recording transactions are met, they are also met for the resulting in balances. When the system of internal controls meet its objectives as these relates to the recording of transactions and balances, management assertions are also likely to be valid. The first internal control objective is real, which means that there are controls in place to ensure that fictitious or duplicate transactions are not included in the books and records of the organization. If system of internal control meets this objective, then occurrence, rights and obligations and existing assertions are also likely to be valid. The second internal control objective is recorded, means that there are controls in place that will prevent or detect the omission of transactions from the books and records of the organization. If systems of internal control meets this objective, then accuracy, completeness, and valuation and allocation assertions are also likely to be valid. The third objective is valued, which means that there are controls in place to ensure that the correct amounts are assigned to the transactions. If system of internal control meets this objective, then accuracy and valuation and allocation assertions are also likely to be valid. The fourth one is classified, which means there are controls in place to ensure that the transactions are allocated to the correct general ledger account. If system of internal control meets this objective, then accuracy, valuation and allocation and classification assertions are also likely to be valid. Alright, so there are controls in place to ensure that the transactions in the books are records are summarized and totaled correctly. If system of internal control meets this objective, then by this objective I mean the summarized objective, which are in place to ensure the transactions in the books are summarized and totaled correctly. So if the system of internal control meets this objective, then accuracy and valuation and allocation assertions are likely to be valid. Posted. There are controls in place to ensure that the accumulated totals in the transaction files are correctly transferred to the general ledger and subsidiary ledgers. If system of internal control meets this objective, then accuracy, valuation and allocation and classification assertions are likely to be valid. Timely is another. There are controls in place to ensure that transactions are recorded in the correct accounting period. If system of internal controls meets this objective, then cutoff and completeness assertions are also likely to be valid. When the auditor gains an understanding of the client's system of internal controls and how the client uses internal controls to manage risks in the business. It's important for the auditor to remember each of these objectives. By focusing on these objectives, the auditor will be able to select the appropriate control of tests to gain the greatest level of assurance possible that the client system of internal controls is operating effectively. If an entity's controls fail to meet any of these objectives, then this will be classified as a weakness in internal control. Internal controls, no matter how effective, they can only provide reasonable assurance in achieving the financial reporting objectives, as there are some inherent limitations of internal control. Internal controls usually depend both on quality and integrity of people working within the entity and on those people following prescribed policies and procedures. Thus, it is subject to breakdowns caused by carelessness and fatigue, and it can be circumvented intentionally through collusion. The next limitation is management decisions about nature and extent of controls being implemented. As an example of this limitation is like that an internal control may have been designed appropriately but never implemented by management. The control has therefore no ability to mitigate risks. Management may also override the controls. Internal controls are designed to prevent fraud or errors by people operating within the system. Quite possible that someone in the supervisory position may perpetrate fraud by acting outside the system. Undue reliance on management to automatically do the right thing may create opportunities for the managers who lack integrity to behave inappropriately. The next one is the existence of non-routine transactions. In an organization, most control activities are directed at routine transactions rather than non-routine transactions, and therefore controls may become inadequate due to changes in conditions. The last one is management estimation. Management also makes accounting estimates such as allowance for doubtful accounts, receivables, and even selects accounting principles such as methods of accounting for inventory, for example FIFO, or average cost, that are subject to judgment. Therefore, the reliability of financial report is not assured even if accounting records are reliable. Thank you. And in the next video, we'll talk about entity level internal controls.